What's up, Radar Gang? Welcome to another Market Radar podcast. It's been a pretty eventful week. NASDAQ did close flat in the last 2 days, Thursday and Friday. We had quite a big sell-off, and it's something that we did call last week. We mentioned that all other indices are bearish trend. The NASDAQ's the only bullish trend index out of all these four, and the S&P actually bounced right off of Momo. If you want to flip to that chart, we could see here it's still holding on to that bearish trend. It was not able to break above Momo and flip to bullish trend. So we are going to continue to have this downward pressure on the NASDAQ and all the other indexes because, as we say, bearish trends tend to lead to lower prices. And so that's our stance on equities right now. Do you want to take us into the VOOTX and what happened this past week regarding that?
Right. So the VOOTX, now what this is measuring, right? It's measuring at the money implied volatility versus the cost for black swan downside protection. That's what this is measuring, right? It's a little bit obscured and kind of hard to follow when you look at the calculations in that manner, but they're not the same, but they have a similar effect, right? So what you're trying to measure the fear in the market versus the demand for tail risk, right? And typically when this gets above 1.5, meaning there is 1.5 times the amount of fear in the market versus demand for tail risk, what you usually see a downtrending or bearish type of market environment. Now, we're seeing the actual complete opposite here play out, right? Ever since Monday, VOOTX has been pretty much getting slammed, right? We went from pretty much 1.5, which is above is generally risk off, down to almost 1 in Friday's trading. So what's going on here? Why is this getting absolutely smoked, but ES, on the other hand, is not down as much? Is there a lag here, or is something on the rise? And the answer is it's not so much of a lag, but it's the idea that everyone is almost at this point understanding the market can go lower, right? And what's going on here is the reason this ratio is beaten up so much is everyone's jumping on tail risk demand, right? Everyone's fleeing towards tail risk, or I should say flocking towards tail risk, right? So they're trying to protect that tail risk, and that's why this ratio is down. So what that's telling us is even though this ratio is down a lot and the market's down, the demand for tail risk is it's so present that it's almost unlikely the market's going to crash and unfold from here. Doesn't mean the market can't go lower, but this idea of where this type of event here when the market just falls apart, right? Usually you need that demand for tail risk to not be present because the market doesn't fall when everyone's hedged for it, right? That's not how it works. It's pretty much the market falls apart, catches everyone by surprise, and then when everyone's all hedged up for downside, they're basically pretty much, or I should say, they're hedged up for the worst case scenario, which is further tail events. That's when those tail events dissipate and the market actually reverses, right?
So would you say that the most likely outcome for equities over the next month or two would be chop and slightly lower?
Most likely that's the case. Yeah, and I think that for us really to see a pickup in that bearish type of price action that even you were just talking about earlier, we're going to need to see NQ back under Momo and bearish trend. I just don't see how you have a market fall apart aggressively without NQ in that bearish trend territory, right? Because at the end of the day, you can argue all you want about the NASDAQ for example, the NASDAQ's up 36% year to date. The S&P 500 is only up 11, right? There's obviously a price disparity. There can be some type of rebalancing where the NASDAQ comes down a lot more than the S&P, or the S&P goes up a lot more than the NASDAQ. They meet in the middle. Long story short, right? You can have these different types of scenarios, but you need the trends to align for those things to happen, right? So if you want the NASDAQ to come down and catch up to the S&P 500, well, it's going to need to get under Momo to do that, right? And unless you're under Momo, bearish or bullish trends tend to lead to higher prices. So I don't see the market falling apart that quickly without NASDAQ under Momo. So if you're short the market right now, keep that in mind, right? obviously we're not going to be short the Nasdaq, right? If we were to short the market, we're not shorting the Nasdaq. It's a bullish trend. But let's just say you were short the S&P 500 and you got in. Let's just say you use this Momo as the Momo line here, which was at 44.18, as like that wall to enter into, right? You let price come up, you smashed into that, you went short here, and now you're sitting short. Now you're concerned. Well, what is going to happen next, right? How does this play out from here? Well, it's pretty simple. This is bearish trend. It can trend lower. But we saw this big volatility. VIX exploded, right? VIX was up over 20% at one point on Friday, and everyone was so concerned. But that type of rapid movement and this type of rapid movement in VIX, this one-day candle wide wick, everybody's jumping on that on the black swan tail protection, right? The like doomsday puts. That's what we can call them, right?
But
everyone's
especially
like, you know what?
with the war going on that just
Right.
started.
Exactly. Everyone's just full. Everyone's like, oh, this is it. We're going to get a crash, right? So that's why the Volley TDEX pretty much got beaten up so bad on Friday. And it's been getting beaten up all week because this was that war. Everyone's like, okay, you know what? There's tail risk here with a war. Something could happen. The unthinkables could obviously become thinkable, or the improbables become probable. So we're going to hedge up accordingly. And that's almost like, I don't want to say it's a bullish indicator for me, but it's almost something that's like, okay, like Wall Street's almost prepared for this. So those types of circuit breaker events, right, where things go, those types of events happen. Specifically, I don't want to use circuit breakers. The last time that happened was because of COVID. That's just such a rare and improbable situation. That's even more improbable than anything. That's like nuclear war type situation, right? But long story short, the market could fall apart, but it's not going to have that aggressive selling that even we saw here with this type of straight, just absolute destruction, right? Especially when everyone is chasing for that doomsday hedge. It's very hard to push prices further because everyone is not going to be if you're hedged, you're less likely to be selling things aggressively out of panic, right? Because you're protected. So
Right.
it kind of slows the selling down.
Speaking of the war premium, we saw gold today on Friday when we're recording this. We saw gold skyrocket. Let's talk about that and why that happened. Is this purely just war premium that's causing this?
I think there's a lot of factors that come to gold, all the way from war premiums is one of them, down to central bank balance sheets, right? And just global balance sheets. Because we've spoken about this in the past, right? Gold is a unique security. It's a zero coupon bond with no default risk. And what that basically means is think of it like a treasury bond. I didn't say a zero coupon treasury bond. I said a zero coupon bond, right? Because it's the universal bond against all central banks. It's not just for the United States, right? It's a zero coupon bond, so it doesn't pay any interest. And it has no default risk, but it trades like a bond. So when it does really well, it's typically in falling interest rate or falling real yield environments. When it does poorly, typically it's when rates are rising / real yields are rising as well. So you want to own gold in that falling real yield economic slowdown type of environment, not really in an environment where real yields are up near highs, continuing to rise, rates are up. Gold really needs rate cuts. Gold really needs QE. That's really what it needs.
Well, so why is this happening? Because real yields are still remaining really elevated, only with a slight pullback. Is gold front running a drop in real yields? Is that something that's possible?
It could be, but I highly doubt it. I think what gold is doing is it's doing the Ukraine war all over again. Now, the Ukraine war obviously had bigger supply shock implications than what we're seeing right now, but it's very hard to tell, right? We're only 1 week in. Ukraine war has been going on for over a year now, and like things have pretty much come to everyone's come to an understanding of what to expect there, right? But gold did something very similar. See where like real yields aren't down much, but gold's shooting up. It did something along the lines of this like last year when the war broke out, right? Gold pretty much shot up, and we called it up here. We said this was a fake breakout. It's not going to work. Odds are to the downside. Now you might be saying, well, how could you say that if the trend's bullish? And this all comes back down to the correlated trade for gold. gold and bonds will move together. What happened here was there was this war premium going on the other side of the world with this Ukraine war. Gold got the bid. The problem was rates in the United States and also the rest of the world, but more so the United States, were so restrictive, and financial conditions were getting tighter and tighter and tighter. But real yields were not going, or I should say, and real yields weren't going down, because real yields going up, right? This is just another metric for financial conditions. Real yields going up means financial conditions are getting tighter. So really, financial conditions getting tighter, gold going up, but we know that gold really needs QE to excel. Gold needs lower interest rates. So even though the trend's bullish, and you might think, oh, well, bullish trends lead to higher prices. Yes, that's true, but not when you don't understand the context of the regime that you're in and what's going on with interest rates and the main drivers behind gold, interest rates. So what ended up happening here was we called this top. We said, this is bullshit. This is not going to work. This is not going to stick. Sure enough, this fades down, goes back to bearish trend, goes back to bullish trend again. We said the same thing, not going to stick. If gold goes bullish trend here, real yields are still up here and nowhere near bearish trend. I again will tell you that this bullish trend in gold, if it were to happen, will not stick. What this is it's again a culmination of war pricing, fear. Everyone's worried about the United States debt rating, right? People are talking about, oh, this debt's unsustainable. This debt path, obviously, yes, we all know this debt path over the long run is unsustainable to a degree, right? Things can be changed in the process to make it sustainable. Not so much more debt, but the current debt levels. Long story short, gold is not the driving factor here behind this whole economic slowdown yet, right? Not a way to play the economy at this cycle just yet. You don't want to own gold when real yields are up. So I plead with you and say, if gold goes bullish trend, understand the regime that you're in. If we start seeing bonds breaking out, real yields breaking down, oil breaking down, and gold breaking out to the upside, I'd say, okay, this has a bigger probability of sticking.
Right. And then once we see all of those things, that's a sign of stage 4 starting.
Exactly. Now, what people are going to get confused with here is they're going to start to see gold going up and they're going to say, oh, this is the trade. This is where we get that breakout in gold. This is it, right? And I want to, again, tell you, can gold go higher? Yeah, I mean, gold has held up a lot, much better than bonds have, right? Real yields going up is bad for both bonds and gold. Bonds have gotten smoked a lot more than gold. Now, the difference there has to do with the fact that there's a lot of other driving factors. There's many driving factors, right, in bonds. It can be credit risk, duration risk, inflation risk, right? There's so many different things that in the bond space, where gold doesn't have credit risk and gold doesn't have counterparty risk, right? So they can't default, and gold itself can't basically vanish out of thin air, right? A country can't devalue gold, right? They can't reprice gold.
Right.
Right? So when bonds fell the way that they did, everyone thought the system was going to break, right? The Fed's going to hike interest rates. Something's going to break along the way. The United States would change, therefore. Bond prices are going down according to that. Real inflation, all these things are going on. Gold doesn't have a lot of those factors that it needs to price in, which is why gold held up much better in this scenario. But typically, when all things are the same and we have a regular tightening cycle where inflation isn't running rampant, we don't have a war, we don't have contagion risk around the world with banks, right? Think about SVB, all these things that are going on. When we don't have that type of environment, when it's just an economic slowdown, which happens, right? Gold goes up, or gold goes down, bonds go down in the process. We then get the pivot where they both go up together. What ended up happening here, though, is everything deviated so far where gold didn't actually get hit that much. Real yields went up a lot since 2021. Bonds didn't really get smoked that much since 2021. And the reason behind that, again, is due to that zero coupon factor. It's basically a long bond. And if you remove all of the nonsense from all these different central banks, from all these bonds, I believe you would see something very similar to gold in the aspect that there's no default risk here. There's no issue. No one's going to slam your duration, right? With more treasuries, issue more debt. These things don't don't exist in the gold world. That's why gold has held up so well, because you have less liquidity risk as well compared to bonds. So I think that again, gold is moving the way it is right now due to some certain events that are going on, but it's not what most people are thinking of. You're not getting that move in gold that, in my opinion, just yet, that's going to send gold to $2,500, $2,800, $3,000 an ounce, which most likely will happen throughout stage 4 and the next deflationary regime. But until then, I don't think gold's going to work out too well. And again, this goes back to what I just said earlier about oil, right? If oil's up and gold's up, it's not the gold trade, right?
So let's talk about oil. So how is this war affecting oil, and how is it going to affect it going forward? So far, it seems like it's not really making a difference in the oil world.
Right. So I think, the United States, right? The United States sources 60% of its imports of oil from Canada. I think 7% comes from Saudi Arabia. I'm sure there's it gets broken up along that way, right? The extra 23%, some along the lines, right? But the majority of America's oil doesn't come from Saudi Arabia or any of these regions, right? So I do think that in terms of America, it's not as substantial. Now, obviously, if this was a war directly with, involving OPEC and the United States, it'd be a different thing. I think that there's this hiccup can affect oil with the surrounding countries, but I don't think it's going to be a direct driver for sending oil up 30, 40%, right? Be wrong. But we have to lean on the fact that oil is bullish trend. So oil can go up. I just don't think it's this doomsday thing that everyone, $100, $150 a barrel, everyone's getting all hyped up that oil is going to hit all new all-time highs and whatnot. I think that's a little too aggressive. Now, generally what happens is, as you remember the compound landing, if you guys are new, it's our economic framework for the current cycle. It's pinned, it's in our highlights section on our Twitter account. You can find it more on there, find more about it on there, and basically sum it up. We sum everything up and you can get a general idea of what it is. But long story short, there's 4 stages. Stage 1 and 2 are complete. And typically stage 3 is a fast stage. It's something that comes in quick, maybe a quarter or two, and we go to stage 4. Stage 3 in this environment, due to everything being so whipped around and elongated, can last a bit longer. Typically what happens in stage 3 is the economy tries to normalize without understanding what's going on in the process, right? So when you price in a soft landing, what's basically happening is the market saying, okay, there's no recession. We don't need to discount interest rates on the long end of the curve, meaning we don't need to have an inverted yield curve because there's no reason that I should accept borrowing 10 years out lower than where I can today if there's no recession. And what ends up happening is long end starts lifting. And it doesn't go completely positive, right? But it starts lifting to the point where people are like, okay, higher rates, there's no recession. And what all that does is add further restrictiveness to the economy in the process, right? And then you're basically just increasing the power of the recession under the skin. You just you don't realize it yet. In this whole process, in this whole part of the cycle, and part of the compound landing stage 3, it's not uncommon to see oil prices actually go up into the recession. Now you might be thinking, well, why is that? How is that possible? Why would oil prices go up into a recession? Well, what ends up happening is by the time growth slows down in the economy, right? Let's just break down the path of slowing growth. You can start thinking about growth slowing at the production level, right? Where as things are produced, companies are producing less, right? Their output is less. That flows down out into the economy, then GDP is less, right? So by the time we see a pickup in the economy and GDP, production across the chain has already slowed. So by the time we realize a recession is here, what ends up happening is a big driver in stock prices and all financial securities is consumer confidence or investor confidence. If investors think that there's going to be a recession, they're going to start selling. And the slowdown happens earlier in the curve than by the time even the market picks up on it. So what ends up happening is production starts to slow, even in oil. But demand doesn't slow down just yet because there's a lag there. So what ends up happening is your supply is basically coming down, but your demand is still somewhat resilient. And this pushes energy prices up. Now, the difference in this shock, the degree of this shock can be minor or can be severe. depending on that, on how minor or severe that is, the impact on oil prices will tell you that as you go up into the recession. You can look at something like 1980s, 90s, 2007, first 2001. You can look back and see how oil has moved differently into those recessions. But long story short, oil going up isn't the most bullish sign that you can possibly see. And we've been going over this in general with commodities, right? Commodities, DBC has held Momo, surprisingly. I really did think, oh man, a couple more days here, maybe we get the rollover and get bearish trend again. Nope, we're back in the green here. So DBC has to get under Momo here to really flip the trend back to bearish, to really get the stage 4 fears going. But the idea here behind stage 3 is that the economy is going to try and normalize. In the process, commodities should go higher as the economy tries to normalize, right? Because commodities are a signal that demand is robust still, even though and supply can slow, production can slow, but if demand remains robust and that lag is there, you get that stage 3 fake commodities effect where, oh, everything's okay, everything looks good, and then what ends up happening is you finally get the fallout in that demand, and that brings you right to stage 4. So if you're looking for stage 4, you're not sure what to look for. Obviously, you hear us talk about stage 3 all the time. You hear us tweet about, or you see us tweet about it, and you hear it in our podcast. So how do you prepare for it? Well, there's certain things. Number one, commodities in stage 4 need to be bearish trend. Gold needs to be bullish trend. Bonds need to be bullish trend. Now you might be thinking, oh, okay, that means equities need to crash. No, this is the big trick. Because unless this slowdown is going to outprice that growth slowdown that we saw in 2022, or that expected growth slowdown, right? Unless we can outprice that, the market doesn't need to go under the 2022 lows. Surprisingly, I know, right? Everyone's like, oh my God, like S&P to 3,000. Like that doesn't need to happen.
Yeah,
Could it happen?
It almost seems like the best risk to reward play is going to be bonds and gold when the time comes, when stage 4 comes around. The way to play the recession is not going to be to short equities, because they haven't really fully recovered from that 2022 low anyway. So you're kind of fighting an uphill battle if you're trying to short equities during stage 4. But bonds have been beaten down so hard that when stage 4 does come, those are going to slingshot higher, especially as the Fed has to cut rates.
Right. And I think that a good position or good viewpoint to take on that, right, is what happens, can the yield curve revert without a recession, right? It's everyone's big thing. And it depends on the depth of the recession. I don't think we're going to get an official recession if GDP doesn't go under 0. And what I think is a possibility here, the long end rises as it's been doing, and we're not seeing this economic slowdown just yet. And this, I think, this is stage 4, but I think most of you guys listening are going to be confused when I tell you this, that the Fed is going to start to see inflation expectations fall, right? And we'll look at real yields for this example, right? So the break evens will start falling, and the long end will remain elevated because the Fed's going to be, quote unquote, restrictive, whatever. Break evens start falling. The Fed's going to actually have to start reducing interest rates slowly. And what they will do in the process is they'll actually enable a bull steepener. But if they reduce interest rates at a slow enough rate and inflation expectations are falling slowly, right, and growth kind of just flatlines at 0, it'll be a shit stock market for sure. But it won't be like we're not talking about a financial crisis, but it'll be a pretty shitty stock market environment where it's almost like stagflation, like when you think about it, just the market just chopping, going nowhere, right? It's stage 4. I think bonds and gold will be doing quite well because the Fed will be bringing interest rates down, not rapidly, but real yields will be falling in the process, right? Or the Fed will try and keep real yields consistent, but the Fed will have to pretty much keep up with real yields at that point. And I think that the Fed will end up over tightening, but I don't think it's going to be like this whole systematic bank failure. Everyone's expecting an SVB type of event where everything should start breaking, like 2008, banks going belly up overnight. don't think it's going to play out like that. I think if we do get a harsher stage 4, it will start off exactly how I said, how I just depicted it to, and then we'll break off from there. We won't just wake up one morning, market down, just really in the gutter. I don't think it's going to play out like that. I think that there's too many people, and you can call this simple thinking, but I think there's too many people prepared for a recession. There's too many people that are on the right side of the trade right now. And I think what's going to have to happen is they're going to start to see the market come down, maybe just a little bit, growth slow down, and they're not going to understand why the market's not going down. And they're not going to see bonds moving either. And they're going to end up getting chopped up in equities, and the bond trade's going to come to fruition. And when it does, I think all the smart money is going to see that transition, that stage 4 pivot, and go into bonds and gold. There'll be ample opportunity there to make money, but equities may just do absolutely nothing in stage 4. They may not crash down to new lows. We might not even see early 2023 lows, SVB lows. Like, you have to just be open-minded to something like that. Like, it's possible. That's why shorting markets are a lot harder than longing markets, because over the long run, you have the odds are in your favor for higher prices. So to go short the market, you have to be very, very, very tactical when you do it. You have to be in and out. There's not a large room for error. So I don't think, like you said earlier, the optimal trade will be to short equities. If you are short, and you're short in the Momo, let's just say you did that, bearish trend, seems good to me. I would keep the stops tight on this, and I would just manage the position, man, because things can happen quickly here. This can chop sideways, we can get something like this. This is possible. An environment like this, right? Just nothing. Absolutely nothing. And I think that you have to be prepared for that in stage 4. Stage 4 might not be this whole recessionary theme that everyone's talking about, systematic breakdowns, like I said. So keep that in mind. I think that watching the market from here, watching gold from here, if you're, like I said earlier, bullish trend, just make sure we have the real yield and bond alignment. Otherwise, it is a fake breakout. Other than that, I think that's where we'll wrap up the podcast today. Thank you guys so much for listening. If you have any questions, you can reach us on Twitter @TheMarketRadar or our website at market-radar.com.